Okay, let's dive right in. If you've ever, really committed to building up your credit, paid every single bill right on time, religiously, but then you hit a wall, your score just kind of stalled out after those first few months,
hmm
well, you might actually be making one of the most common and honestly most expensive rookie mistakes out there in personal finance.
Yeah, that's unfortunately really common. And that mistake, when you boil it down, it's the cost of rushing things.
Yeah.
Our sources, the data we're looking at, it's incredibly clear on this. It starts with a pretty bold statement, really.
Okay.
Most people actively sabotage their own credit journey right in the beginning, like the first 6, maybe 12 months,
Oh.
by trying to open way too many accounts way too fast. The classic scenario we see is someone applying for, say, 4 or 5 different subprime credit cards, maybe store cards, all within about half a year.
Right, because it feels proactive, doesn't it? Like
Yeah.
you're checking all the boxes, building that history quickly.
Exactly. It feels like you're doing everything you possibly can. But the reality is that sheer speed, it's actually detrimental. Lenders don't see that rush as ambition.
They see it differently.
They often interpret it as desperation
Hmm.
or instability, and it leads directly to your score just stagnating, hitting a plateau. And the irony is it actually delays your access to the really good stuff.
The things you were aiming for in the first place.
Precisely. Those prime credit cards with great rewards, the low-interest mortgages, the better car loans, all the things that signify real financial leverage. That initial rush pushes those further away.
Okay, so this is why we're doing this deep dive today, right? To lay out this blueprint.
Exactly. The strategic account layering blueprint. It's a very calculated, disciplined method. It's specifically designed to help you avoid all those unnecessary hard inquiries, minimize the friction in the system, and really maximize the positive punch of every single new account you decide to open.
So we're taking it from a scramble, a guessing game.
Yeah, turning it from a scramble into a deliberate, calculated,
Yeah.
honestly, a power move in your financial strategy.
And I want to stress, like you said, this isn't just about generic credit tips you hear everywhere. Pay your bills on time. We know that.
Right. We're framing this strategic layering as something much bigger. It's really a foundational wealth-building tactic. It's not just about getting a slightly better score next month.
It's an insider's advantage almost.
It truly is. Because when you execute this blueprint the right way, and that means with patience, with precision, the payoff is huge.
Mm.
You stand to potentially save thousands, literally thousands,
Mhm.
in future interest costs on big loans.
Okay.
You dramatically improve your odds of getting approved for those top-tier prime products. And fundamentally, you accelerate your overall funding power years faster than the average person who's just winging it.
So the core idea is efficiency and thinking long term.
Pure efficiency and long-term positioning, that's the goal.
Mhm.
You want to open accounts strategically with very specific, almost mandatory time gaps between them.
Gaps are key.
Gaps are absolutely key. To maximize the average age of your credit history, which is a huge scoring factor, and to efficiently build the right credit mix from the start. That blend of installment debt, like loans, and revolving like credit cards,
You need both.
you absolutely need both for the algorithms to see you as well-rounded. And critically, once you establish that mix, you have to let it sit, let it season.
Okay, let's unpack that. Let's get into the mechanics here. Because the common wisdom, or maybe the common misconception, is more credit equals better credit, and faster is better. Get those accounts reporting.
Right.
But our sources are saying, hold on, that's wrong. They're warning about the dangers of speed. So what's the actual damage? What does rushing do to a brand new credit file? Or maybe a thin file?
Yeah, we really need to define this danger zone clearly. We call it the rookie mistake zone. This is typically that first, say, 12 to 18 months of a credit file's life.
The critical early period.
Exactly. Where applicants, often with the best intentions, inflict massive self-sabotaging damage on their own profile. And it usually happens because they just don't understand how lenders assess risk, especially based on 2 major score components that get hammered when you apply too fast.
Okay, let's hit the first one. The one people sort of know about, but maybe don't grasp the full impact of hard inquiries. Every time you apply, bam, you get one.
That's correct. A hard inquiry or a hard pull is generated anytime you formally submit an application for new credit. Doesn't matter if it's a primary credit card, an unsecured personal loan, a mortgage, an auto loan, even some of those high-limit store cards.
Anything where they check your credit to make a lending decision.
Right. The lender pulls your full credit report to assess your risk level, and that action leaves a visible mark on your file. This mark, often called a score ding, it's temporary, but it's potent.
How long does it hurt you?
Well, it can impact your score negatively for up to 12 months, and the inquiry itself stays visible on your report for up to 2 full years.
Okay, but practically speaking, how much damage are we talking? Because I hear people say, oh, it's only 5 points, I can handle that. Is it really just 5 points?
That's where the misunderstanding lies.
Yeah.
It's rarely linear, especially when you stack them up quickly. Our data, what the sources show, is that, yeah, a single isolated inquiry on an otherwise healthy, established file might only cost you, say, 3 to 5 points, maybe less.
Okay.
But stacking 4 or 5 inquiries within a short window, like 6 months, that completely changes the lender's perception. The automated underwriting systems, the algorithms, they detect this cluster.
And they don't like clusters.
They hate clusters. They interpret it as high-risk behavior,
Desperation.
financial distress. The sources suggest this clustering effect can easily wipe out 30, 40, even 50 points almost instantly.
Wow, 50 points. That's not trivial at all.
It's huge. Losing 50 points just from applications is like erasing an entire year's worth of perfect, positive payment history that you might have built up. It takes a monumental effort to claw those points back, and that effort is completely wasted because the damage was self-inflicted right at the start.
So the distinction is really important then. One inquiry might just be shopping around, exploring options.
Exactly.
But a bunch of them close together screams, I need cash flow now and I can't get it through normal means.
You nailed it. It signals instability. And it actively prevents the underwriting software from even seeing the positive things you might be doing, like paying on time. It just raises red flags. But, the damage from hard inquiries, that's only half the problem when you rush.
Okay, what's the other half?
The second component, and this one is often more insidious, more damaging long-term, is how rushing sabotages your average age of accounts, or AAO.
Yeah, yes, AAOA. It's a big chunk of the length of credit history part of your score, right? Which is like 15%.
That's right. It's a significant factor. Yet it's the one that people rushing to grab every card offer completely overlook, or they don't understand how devastating opening new accounts can be to it.
So explain that. How does rushing kill your AAOA, and why should a lender even care how old my accounts are on average?
It's actually very simple math, but the strategic implications for your future borrowing power are enormous. AAOA is just what it sounds like. The mathematical average age of all your active reporting credit accounts.
All of them combined.
Every single one. Loans, cards, everything. And lenders fundamentally are obsessed with long-term data. They want proof of stability over time. And stability in their eyes is practically synonymous with age. Older accounts mean more data points showing reliable behavior.
Okay, so let's run a quick scenario. Say I'm starting out, I got a secured card, maybe it's 18 months old now. Pretty good start. My AOA is 1.5 years.
Solid foundation.
Then I listen to some, let's say, bad advice online, and I get excited and apply for 3 new store cards and maybe another subprime card this month. 4 new accounts.
It's okay. Disaster scenario incoming.
What happens to my AAOA?
Okay, so you had 1 account at 18 months. Now you add 4 brand new accounts, each with an age of 0 months. Your total number of accounts jumps from 1 to 5.
Right.
So you average that out. 18 months plus 0 plus 0 plus 0 plus 0 divided by 5 accounts. Your AAOA instantly plummets from 18 months down to just 3.6 months.
Wow. From a year and a half down to less than 4 months.
Exactly. You just took a profile that was starting to look established and instantly reset it. In the eyes of those underwriting algorithms, you turned it back into a thin, volatile, high-risk profile.
That's a massive step backwards. It feels like I punished myself for trying to build more credit.
That's precisely what happens. You've effectively hit the reset button. You've replaced an aging, stabilizing profile with a file that's now dominated by youth. And youth, in credit terms, signals volatility and unknown risk to a lender.
So the sources are clear on this. One older account is better.
Absolutely definitive. A single, well-established older card, even if it started its life as a basic secured card just a year or 2 ago, is worth far more to your overall profile strength and to a prime lender's perception of your risk than, say, 5 newly opened, young subprime cards with tiny limits.
Even if the total credit limit is higher with the 5 new cards.
Even then, in many cases, especially early on, because the rapid introduction of those young accounts tells the lender you might not be able to sustain growth gradually. You look like you're scrambling.
So this really drives home that less is more idea, especially at the very beginning.
Yes, that's the foundational principle. The strategic objective in the early stages is to stabilize the file, nurture the first 1 or 2 accounts you open, and allow them to establish deep roots before you start layering on more volume.
Think of it like planting a tree, maybe. You let the first one get established before planting a whole forest around it.
That's a great analogy. You are far better off having one solid account that's 12 months old, showing a year of perfect history, than having 4 accounts where the average age is only 3 months. That latter profile, regardless of whether you pay the bills on time, is flagged by the system as inherently riskier. It's the metric of stability, the age, not just the number of accounts, that unlocks access to the best prime credit products later on.
Okay, that makes perfect sense. So we've diagnosed the mistake rushing, the rookie mistake zone. Now let's pivot to the cure. This is where the blueprint really starts, the battle plan.
Exactly. If rushing is the problem, then precision timing is the antidote. We need to establish a solid foundational base first. And the blueprint calls for getting 2 primary accounts on your file early on, but they serve 2 very different, very strategic purposes that work together.
2 different types of credit, right?
Precisely. This strategy is all about addressing that crucial credit mix factor right away and doing it efficiently. Credit mix, the blend of revolving credit-like cards and installment credit-like loans, it only accounts for maybe 10% of your FICO score directly.
But it punches above its weight.
It really does. Because establishing it quickly proves to lenders that you can successfully manage different types of debt simultaneously. That's seen as a key maturity metric. It shows you're not a one-trick pony.
Okay, so phase 1, where do we start? Month 1.
Phase 1, the absolute first step, strategically placed right in month 1, is establishing that installment credit trade line. And notice, this happens before you even think about applying for a regular credit card.
And the tool for this job, the recommended one, is the credit builder loan, the CBL.
Correct. The credit builder loan is almost perfectly designed for this specific purpose, establishing that necessary installment loan trade line when you might not qualify for anything else.
Why is that so crucial? Why the loan first?
Because someone's starting completely from scratch, or maybe rebuilding after some issues, they rarely qualify for a traditional personal loan, certainly not an auto loan or a mortgage yet. The CBL is kind of an artificial structure designed specifically to fill that gap in your profile.
Okay, for listeners who maybe haven't come across the CBL before, can you break down how it actually works and why is it considered so safe for a new credit builder?
Yeah, the mechanism is actually quite ingenious, and it's inherently low risk for both you and the lender. Essentially, a bank, or more often a credit union, lends you a small amount of money, say $500 or $1,000.
Okay.
But here's the key. They don't just hand you the cash. They immediately place those funds into a locked savings account or maybe a certificate deposit CD that you cannot touch.
So the money is secured.
Exactly. It's fully secured by itself. Then you make regular monthly payments on that loan, typically for a term of 6 to 12 months, sometimes up to 24 months.
Paying back the money they're already holding.
Right. You make all the payments, fulfilling the loan agreement. Once the loan is fully repaid, then they release the original funds, plus maybe a tiny bit of interest earned back to you.
Ah, I see. So you get the money back at the end, but the real benefit is what happened during those 6 or 12 months.
That's the magic. During that repayment period, you are actively generating 6, 12, maybe even 24 months of perfect, positive installment loan payment history that gets reported to the credit bureaus.
And that plugs the installment credit hole in your profile?
Precisely. But what's really fascinating here, and the reason the CBL is strategically placed in phase 1, is often the type of inquiry it generates.
Ah, back to inquiries.
Yes. Because the funds are fully secured by your own payments into that locked account, the initial setup often results in only a soft inquiry on your credit report. Or, in some cases, it's structured as a guaranteed approval product for members, completely bypassing the need for a hard inquiry.
That's a huge advantage.
It's the key leverage point early on. A soft inquiry, or no inquiry, means you establish your very first trade line, you start building that positive payment history without incurring that damaging cost of desperation scoring that multiple hard inquiries signal. It's a clean, super low-impact way to get your installment history started.
Okay, phase 1 done. CBL in place, reporting positive payments, minimal inquiry damage. What's next? Phase 2.
Right. Once that CBL is officially established and you see it reporting on your credit monitoring, which usually takes about 30 to 45 days, we move fairly quickly, typically in month 2 or maybe month 3, to establish the other crucial half of that credit mix, revolving credit.
This is where the credit card comes in.
This is where we introduce the secured credit card.
Now, this is going to be the first primary revolving account on the file, and the sources really emphasize that the choice of which secured card you get is vital. It's not just any secured card. Why?
Because this specific secured card, the one you choose in phase 2, is very likely going to become the long-term anchor, the cornerstone of your entire credit profile for years, maybe even decades down the line.
So you're saying it could become your oldest account eventually?
That's the critical insight, yes.
Yeah.
Assuming you manage it perfectly, this secured card has the potential to become your longest-lasting trade line. That's why we absolutely must stress the importance of selecting this card carefully. You want one from a primary established bank or potentially a well-regarded credit union.
Okay, but why does the brand name of the bank matter so much at this entry level? Aren't all secured cards basically doing the same thing? You give a deposit, you get a card.
On the surface, maybe, but strategically, they're absolutely not the same, especially when you're playing the long game, thinking years ahead. Primary banks, we're talking about the big players like Capital One, Discover, maybe Bank of America, or certain programs from major credit unions, they matter for two really big interconnected reasons.
Okay, what are they?
First, they generally offer much better account monitoring tools, mobile apps, and educational resources. That really helps a new builder stay organized and on track with payments and utilization. That's helpful, but it's not the main reason.
What's the main reason?
The second reason, and this is the real strategic advantage, is that these major issuers often have clear, established, and often somewhat predictable graduation programs.
Ah, graduation. That's the magic word with secured cards, right?
That's the goal. Graduation is that moment when the bank reviews your history with the secured card, decides you're now a good risk, and converts it into a regular unsecured credit card.
And they give you your deposit back.
Exactly. They return your security deposit, and often they'll give you an automatic credit limit increase at the same time without you even needing to apply or get another hard inquiry.
So you need to pick a card up front that actually has a graduation program.
Yes. And ideally, one where the path to graduation is reasonably clear and well documented, even if not explicitly guaranteed. You want a card issuer known for graduating cards, typically within 6 to 12 months of consistent, perfect use. On-time payments, low utilization.
So if you choose wisely at the start.
If you choose wisely, this secured card, which began as just a basic foundational builder tool, will eventually graduate. It then becomes your oldest, most established, potentially high-limit, unsecured revolving account. It's the bedrock of your long-term credit history.
That really does sound like setting up a long-term anchor for your whole file.
It absolutely is. So once Phase 1, the CBL, and Phase 2, the well-chosen secured card, are both established, and crucially, they've both started reporting positive information to the credit bureaus, that completes the foundational phase.
Okay, foundation laid.
Now, the fight needs a little bit of time. It needs a moment to kind of consolidate that information, or as we call it, the blueprint, it needs to season. But actually, before we dive into that really critical seasoning phase, this seems like a good spot to hear from our sponsor.
Good idea. Let's be honest. Nobody likes waking up feeling like last night won. You know that feeling.
Mm-hmm. Definitely know that feeling.
That's why I want to put you on to something that actually works, something I've found helpful. Liquor gummies.
Okay.
These aren't just your average gummies. Liquor combines DHM, that's dihydromyricetin, kind of a mouthful, with milk thistle, B vitamins, crucial electrolytes, and even ginger root. It's a whole blend designed to help your body recover after a night of drinking.
This has got a mix of ingredients working together.
Exactly. This patent-pending blend, it works to help break down toxins, fight off that fatigue and nausea maybe, and importantly, keep you hydrated. The goal is you wake up feeling more refreshed, ready to actually move and start your day. Think of it like smart recovery, right there in a convenient pouch.
Sounds useful.
And because you're part of our community here, you get an exclusive discount, 20% off. Just go to liquor.com, that's Liqure, dbolot.com, and use my promo code BlueprintWins at checkout. All one word, BlueprintWins.
20% off. That's pretty good.
Yeah, 20% off, and there's no expiration date on that code. And full transparency, yes, I do earn a commission when you use my code, so every purchase you make actually directly supports this deep dive and helps us keep doing this.
Good to know.
So if you enjoy your nights out sometimes, maybe make the mornings a little bit easier on yourself. Check out liqueur.com again, that's liqure.oi.com, and use the promo code BlueprintWins.
All right, good stuff.
And we're back, diving deep into the strategic account layering blueprint. Okay, before the break, we established our perfect foundation. Phase 1, the credit builder loan for installment history, minimal inquiry impact. Phase 2, The strategically chosen secured card for revolving history, setting up that long-term anchor.
Yep, foundation is poured and setting.
So now we hit phase 3, and you called this the acceleration phase. This is where things get interesting. We need to kind of artificially age the file and boost our available credit limit without applying for a third primary card yet. We don't want another hard inquiry dragging us down.
Exactly. We need leverage without the application penalty.
And this is where the blueprint introduces, I think you called it a trick, the authorized user status.
It's not so much a trick as a highly strategic leverage play. We call it the trade line power play because it allows you to essentially manipulate two of the most heavily weighted scoring factors, credit age, length of history, and credit utilization in your favor almost immediately.
Okay, so define authorized user, or AU, status for us again. How does that work?
Sure. Being an authorized user, or AU, simply means someone else adds you to their existing credit card account. They're the primary account holder. You're added as a secondary user.
Do I get a card? Do I have to use it?
You may get a physical card with your name on it, but whether you do or whether you actually use it is often irrelevant to the main benefit. The absolute key is that this credit account, the primary holder's account, is now linked to your credit file and starts reporting on your credit report, usually as a positive trade line, assuming the primary user manages it well.
Okay, and you said this gives 2 huge immediate benefits. Let's break those down. How does being an AU affect the scoring models?
Okay, benefit number 1. It instantly bolsters your file's age. This is huge. Your credit file essentially inherits the age, the history, of that primary card you were added to.
So if my own accounts are only, say, 4 months old.
Right. Your CBL and secured card are maybe 4 months old.
Yeah.
But let's say your parent or a trusted relative adds you to their card that they've had in perfect standing for, say, 15 years.
Okay.
Suddenly, that 15-year history gets factored into your average age of accounts calculation. It drastically pulls up your average age, immediately countering the youth penalty from your own new accounts. Your file looks much older overnight.
Wow, okay. That's powerful. What's benefit number 2?
Benefit number 2. It instantly boosts your total available credit limit. It has a massive positive impact on your overall credit utilization ratio.
And utilization, we know, is a giant factor.
Yeah.
Like 30% of the score, right?
Exactly right. 30% of your FICO score hinges directly on utilization. That's the percentage of your available credit that you're currently using across all your accounts. Let's run the numbers. Say your secured card has a $500 limit. That's all the revolving credit you have yourself. If your statement closes with a $50 balance, your utilization is 10%. $50 divided by $500. Not terrible, but not great.
Right.
But now, let's say you become an AU on that relative's card, and that card has a $20,000 limit, and they keep a 0 balance on it.
Okay.
Now, your total available revolving credit jumps from $500 to $20,500. Even if you still only have that same $50 balance reporting on your own secured card, your overall utilization ratio instantly plummets. $50 divided by $20,500. That's less than 0.3%.
That's a huge drop from 10% down to almost nothing.
It's a massive immediate score boost just from having access to that higher limit, even if you never touch the AU card yourself.
So the timing here is key then. You layer in this AU status early. The blueprint says between month 3 and month 6, right after your first 2 primary accounts are established and reporting.
Yes, that timing is strategic. You let your primaries report for a cycle or 2, then add the AU layer. You're essentially borrowing a strong aged history and significant borrowing power, the high limit, to shield and support your own brand new accounts. It makes your overall profile look dramatically more mature and less risky to the next round of lenders you might face down the road.
It's like giving your new accounts training wheels, or maybe scaffolding.
Scaffolding is a great way to put it. It provides instant artificial depth and stability. You gain the benefits of age and limit without incurring another hard inquiry or suffering the AAOA damage that opening a third primary account would cause at this early stage.
Okay, but I have to ask the question, play devil's advocate a bit. You hear things about AU status sometimes. Isn't it a bit controversial? I've read that some of the newer scoring models, like maybe FICO 9 or VantageScore 4.0, are supposedly starting to weigh AU status less heavily. Especially if, like, the last name or the address doesn't match the primary cardholder. Should listeners worry this power play might not work as well anymore?
That is a really vital question, and it actually reinforces why the selection criteria for the AU card are so incredibly strategic and non-negotiable. It's true that some newer, more specialized scoring algorithms might be designed to partially devalue the limit boost component of an AU account if the system suspects it's not a genuine familial relationship, or if it looks like a purely transactional credit piggybacking service, which we strongly advise against.
Okay, so the limit boost might be slightly less impactful in some specific scoring models.
Potentially, in some narrow cases. However, the primary power of this AU strategy, the factor that is much, much harder for even sophisticated automated systems to completely ignore or discount, is the age of the account, the length of history.
So the main goal isn't necessarily just getting that big limit added, although that definitely helps the utilization score. The real prize is inheriting that deep aged history.
Precisely. That's the core strategic win here.
Hmm.
Therefore, the AU card you choose absolutely must meet 3 non-negotiable criteria.
Okay, lay them out for us.
Number 1, the primary cardholder must be someone you know extremely well and trust implicitly. A parent, a spouse, a sibling, maybe a very long-term trusted friend. Trust is paramount, because if they miss a payment, run up a huge balance, it directly damages your credit score too. You inherit the good and the bad.
Okay, trust is number one. What's number two?
Number 2, the absolute must-have. The card itself must be old. Ideally, we're looking for an account that's been open and active for 7 to 10 years, or even longer if possible. The older the better. This is where you get that powerful AAOA boost, that deep-root age.
Makes sense. And number three?
Number 3, and this is critical, that old card must have a perfect or near-perfect, unbroken, long payment history. No late payments ever, or at least not in many, many years. It should also ideally have a consistently low utilization reported by the primary user. This pristine history is what you're effectively borrowing to make your own profile look instantly more responsible and stable to future lenders.
Got it. Trusted person, very old card, perfect payment history, non-negotiable.
It's non-negotiable. If you can secure that, the AU trade line becomes an incredibly powerful accelerator.
Okay, so let's recap where we are. We've got our phase one installment loan, CBL. We've got our phase two primary revolving card, secured card chosen wisely. And now in phase three, months 3 to 6, we've strategically layered on a powerful aged AU trade line. Our file is probably looking pretty darn good on paper around month 6, right? Score might be jumping up.
Exactly. The metrics look fantastic. AOA is boosted, utilization is low, credit mix is established, positive payments are reporting.
And this is the exact moment where the average person feeling confident makes the fatal mistake, isn't it? They see that score jump and think, great, time to apply for everything.
Bingo. And this is precisely where the strategic discipline of the blueprint earns its keep. This is where the real advantage is gained over everyone else. Once those first 2 primary accounts are open and reporting reliably, and that AU account is successfully attached and showing up, the next strategic move is counterintuitive. It's to slam on the brakes completely.
Applying.
Stop all applications for new primary credit. This mandated pause, this quiet period, is absolutely crucial.
Why? Why is pausing right when things look good the most critical part? It just flies in the face of that instinct to capitalize on momentum, doesn't it?
It absolutely does. It feels wrong. But this pause, typically lasting from about month 6 all the way through month 11, maybe even month 12, this is the secret sauce. This is the seasoning period. We must stress the importance of letting the account season.
So no new primary cards, no new loans between month 6 and month 12.
Correct. New primary credit applications must be halted completely after those initial 2 foundational accounts, CBL and secured card, until you definitively reach that 12-month mark since they were opened. And the psychological challenge here is immense. You'll see your score jump, maybe significantly thanks to the AU account kicking in and your own on-time payments. You'll get pre-approval offers in the mail. You will feel ready to apply for better cards.
So the discipline here is paramount. You're basically saying that score jump isn't a green light to apply more. It's actually a signal to stop.
It's a signal that the foundation is strong. Now let it cure. It's a signal to pause and let that strength solidify. This initial pause allows those first 2 primary accounts, your CBL and your secured card, to establish truly deep roots, to build undeniable positive history. They're allowed to age naturally, month after month, for a full 6 months or more, without any new younger primary accounts being added that would immediately drag down that precious average age of accounts again.
Back to the house analogy.
Exactly. You've poured the concrete foundation, phase 1 and 2, maybe added some temporary support scaffolding, phase 3 AU. Now you have to let the concrete cure fully before you start building the heavy second floor. If you rush and start adding more primary accounts too soon, you undermine the strength of that foundation. You end up with a profile that looks wide on the surface, lots of accounts, but is actually very shallow and unstable underneath. Very young AAOA. We don't want wide and shallow. We want deep and stable. That's what lenders reward.
Deep and stable. Okay. That leads us perfectly into phase 4, the long game.
Yes. And if we really connect this whole strategy back to the bigger picture, wealth accumulation, financial freedom, the entire strategy hinges on this principle,
Right.
patience. That seasoning period, that pause, it's not about standing still or doing nothing. It's actually about actively building quiet, invisible leverage. Leverage that compounds exponentially when it's finally time to make your next move in the underwriting process.
So what does that look like practically? On the ground, from month 6 to month 11 or 12, the listener is just paying their two primary bills on time and waiting. Is there anything else they should be actively doing during that 6-month quiet period?
Absolutely. Waiting is part of it, but it's active waiting.
Mm.
First, understand why you're waiting. Lenders inherently reward agent stability in a credit file.
Yeah.
They want to see extensive data month after month demonstrating reliable, predictable, long-term behavior.
So the act of not applying is actually building value.
Yes, not applying for more cards during this critical seasoning period. Months 6 to 11 is in itself a powerful credit growth tactic because you are actively preserving your maturing AAOA. You're preventing any new hard inquiries that would signal volatility or neediness. You're demonstrating financial stability through inaction on the application front.
So the silence is perceived as strength, as self-sufficiency.
By the algorithms and savvy underwriters, yes. It suggests you don't need more credit desperately. But it's not just about not applying. There are active steps to take.
Like what?
Beyond the obvious, ensuring perfect on-time payment history continues without fail on your CBL and your secured card, and also making sure the AU trade line stays clean and positive. This is the prime time to absolutely master your utilization on your own secured card.
Focus on managing the card you have perfectly.
Obsessively. Since utilization is 30% of your score, you want to demonstrate perfect control. During the seasoning phase, you should aim to have your secured card report a utilization rate under 5% and ideally under 1% every single month when the statement closes.
Under 1%. If my limit is only $500, that means reporting a balance of less than $5.
Exactly. Even if you use the card for small purchases during the month, which is good, showing activity, make sure you pay down the balance almost entirely before the statement closing date. Pay it multiple times a month if necessary, because it's only the balance reported on that closing statement that gets sent to the bureaus and calculated into your utilization score.
Wow, that's detailed, tactical management. You're not just letting it age, you're actively maximizing the positive impact of the existing trade lines while they mature.
You got it. You're squeezing every possible point out of the positive history being generated by your CBL and your secured card, all while benefiting from the high available credit buffer provided by your AU trade line, keeping your overall utilization near zero. And crucially, you're doing this without confusing the algorithms with a bunch of risky, brand new, young primary accounts.
Okay. Deep breaths, discipline, patience, managing utilization perfectly. Then what? We finally arrive at.
Then, after months of this disciplined patience, we arrive at the pivotal moment, the finish line for this foundational phase, the 12-month power milestone.
The 12-month mark.
This is the strategic point where all that quiet waiting, all that meticulous management turns directly into tangible financial power. It unlocks access to vastly superior credit products.
Why is 12 months specifically such a magic number? What happens at the 1-year mark, mathematically or psychologically, for lenders?
12 months represents one full, uninterrupted calendar cycle of payments. In the eyes of most automated underwriting systems, a trade line that hits the 12-month mark with perfect history has officially established deep roots. It's generally considered to have moved out of the most volatile, highest risk, thin file, or new account category. It's proven itself for a full year.
So it's like a probation period ending.
In a way, yes.
Yeah.
It's the designated strategic time, according to this blueprint, to make your next move, attempting to get your next primary unsecured credit card.
Okay, so we're applying again now, finally. But the profile under C is radically different than it would have been if we had applied back at month 6.
Right. Oh, infinitely different. Unrecognizably stronger. By this 12-month point, assuming you followed the blueprint, you have shown lenders. 1. Established installment history from the CBL, which might even be paid off by now, showing successful loan completion. 2. Primary revolving history on your secured card that is a full year old, with perfect payments and meticulous utilization control. And 3, you likely still have the benefit of that aged, high-limit AU trade line providing background stability and utilization support.
So the file looks mature, stable, low risk.
Exactly. Compare that profile to the person we talked about earlier, the one who rushed and opened 4 or 5 cards in the first 6 months. At the 12-month mark, their AOA might still be under a year, maybe only 6 or 8 months old. They likely have multiple recent inquiries still impacting their score. They look scattered and potentially risky. That person is probably still stuck getting offers for subprime cards with high fees and low limits.
While the person who followed the blueprint.
The person who followed the blueprint, who showed patience and strategy, is now positioned for prime time.
The prerequisite, though, is absolute perfection for that year, right? 1 full year, 12 consecutive months of perfect payment history on those existing primary accounts, CBL and secured card. No slip-ups.
That is the non-negotiable prerequisite for unlocking the power of this milestone. Perfect means perfect.
Okay, assuming we've done that, what are the tangible outcomes? What can we realistically expect or aim for at this 12-month mark with our beautifully seasoned file?
The outcomes can be genuinely transformative for your financial trajectory. First, you are now perfectly positioned to trigger the graduation of that initial secured card you chose so carefully back in phase 2.
Get the deposit back.
Get your deposit back, have the card convert to a regular unsecured product, and very often receive a decent automatic credit limit increase from the bank frequently without even needing a new hard inquiry because they already have your year-long track record. That anchor account just got stronger.
That's huge in itself. What else?
Furthermore, you can now confidently apply for and have a very high probability of being approved for a prime unsecured credit card offer from a Tier 1 lender. Think major travel cards, good cashback cards, cards with actual benefits.
Because the risk profile looks so much better.
Dramatically better. This established, seasoned profile minimizes the perceived risk in the eyes of the bank's algorithms. And lower risk directly unlocks significantly better interest rates, though you should always aim to pay in full, much higher starting credit limits, and potentially this strong personal profile can even start to pave the way for accessing business credit down the line, if that's a goal. It is the direct payoff for prioritizing depth over diameter, stability over speed.
Wow. Okay, this blueprint really lays it out. It demonstrates so clearly that building real, robust credit power isn't a sprint, it's definitely a marathon. But a marathon guided by precision timing, not just endurance.
Precision and patience, they work hand in hand.
Let's do a quick lightning round recap then. Just hit the 4 strategic phases again so it really sinks in for everyone listening.
Okay, the sequence and the pauses are everything.
Phase 1, right at month 1. You start immediately with a credit builder loan. Goal. Establish that crucial installment history. Key tactic. Leverage the likely soft inquiry for a clean, low-impact start to your file.
Phase 2, around month 2 or 3. Layer in the secured credit card. Goal. Establish your primary revolving trade line. Key tactic. Choose the issuer very carefully, focusing on major banks with clear, known paths to graduation, setting up your long-term anchor account.
Phase 3, between month 3 and month 6. Execute the trade line power play. Goal. Instantly boost perceived age and lower utilization. Key tactic. Attach a carefully vetted authorized user account, must be from a trusted person, very old, with perfect history.
Phase 4. Crucially, months 6 through 12 and beyond. The seasoning period and the payoff. Goal. Allow foundational accounts to mature and build deep roots. Key tactics. Halt all new primary applications. Obsessively manage utilization on your secured card. Keep it under 5%, ideally 1%. Let AAOA grow naturally. This culminates in the 12-month power milestone, where you unlock graduation for your secured card and gain access to prime unsecured credit offers. The reward for patience.
Fantastic summary. And it really reinforces that golden rule we've woven throughout this deep dive. Strategic layering prevents those unnecessary score-killing inquiries. It maximizes the positive impact of every single account you do open, and it ensures you build that essential balanced credit mix right from the very beginning.
And always remember that core principle, especially early on. Less is genuinely more. Calculated stability will beat rush speed every single time in the eyes of lenders who matter.
That stability, that demonstrated patience, that's really what separates the people who build powerful credit profiles from the, 90% who just kind of stumble through it.
I think that's a fair assessment. It's the strategic patience that makes the difference. So maybe the final thought for everyone listening. What stands out to you most about this idea, the compounding power of just letting things season?
Yeah, that's the provocative question.
We really challenge you right now to take a hard look at your own credit situation, audit your current account strategy. Where does it line up with this blueprint? Are you maybe stuck in that rookie mistake zone right now? Did you rush those first few steps?
Be honest with yourself.
Exactly. And if you did, it's okay. But make the strategic choice today to implement the pause. Stop applying for new primary stuff until those foundational accounts you already have open, maybe that first card, that first loan, have reached that deep root status, that full 12-month mark of perfect history.
Because that's where the real leverage starts to build.
That's where your real quiet power truly begins to accumulate. Patience isn't passive, it's potent.